Let's talk about the 8 best dividend ETFs out there on the market that you can invest in today to start making some passive income. Owning dividend-paying stocks is a great way to earn consistent income, and through investing in dividend ETFs, you'll be able to receive income whilst also receiving the additional benefit of diversification, since many of the ETFs I'm going to talk about today contain hundreds of high-quality dividend-paying stocks. Considering we're living in a time when the Federal Reserve is looking to further raise interest rates to try to combat the record inflation we've been experiencing, it's looking like it's going to be a rough time out there for most investors. So in my opinion, dividend ETFs are a far better investment in comparison to a lot of other investments out there on the market right now, such as speculative growth stocks, meme stocks, things that don't have much of a history of profitability. There are a lot of important factors to consider when selecting a dividend ETF to invest in. These include the expense ratio, dividend yield, volatility, market cap, dividend growth, asset allocation, and historic performance. The only problem is that researching these things can be quite confusing for a lot of new investors. So if that's you, don't worry, I'm here to help. The dividend ETFs on my list rank amongst the best out there across all the criteria I just mentioned. This video should hopefully save you a lot of time and frustration. So if you could pay me back for my work by simply liking the video and sharing it with your buddy who just lost his entire net worth going all in on Putin coin, that would be amazing. And you can purchase all of the dividend ETFs in this video conveniently in one place using the Webull app. And you can also receive 5 free stocks by using my affiliate link in the description below. But if you would prefer to purchase the ETFs directly from their providers, I've also included the links to each ETF individually. Anyways, let's get right into it. Number 8 on my list is HDV, also known as the iShares Core High Dividend ETF. This is an ETF that was designed to give you diversified exposure to relatively high dividend-paying companies in the US. This ETF currently holds 75 stocks that have all been screened by iShares for financial health. The ETF consists mostly of large cap stocks. Large cap just means that the stocks are large companies that are valued at over $10 billion. For example, this ETF's top holdings are massive companies that you've probably heard of, like ExxonMobil, Johnson & Johnson, and JP Morgan Chase. Currently, this ETF pays a dividend of 3.4% and has averaged an annual return of 10.32% over the last 10 years. That means if you had invested $10,000 in this ETF 10 years ago, your investment today would be worth roughly $26,702, assuming that you reinvested your dividends to further compound the returns on your investment. Another reason why this is a great dividend ETF is because the fund has a consistent history of increasing dividends, and the majority of stocks in the fund are established companies, meaning this ETF doesn't experience as much volatility in comparison to many other stock market investments out there, like growth ETFs, which makes this ETF a relatively safe investment. This ETF also has one of the lowest expense ratios on the market right now at 0.08%, meaning that on an investment of $10,000, you would only pay $8 a year in fees. That's much cheaper than other investments such as actively managed mutual funds that typically will charge an expense ratio of between 0.5% and 1%, or $50 and $100 on every $10,000 invested. Okay, coming in at number 7 on my list, we have PRF, which is Invesco's FTSE RAFI US 1000 ETF. And whilst the name of this ETF is kind of lame, its holdings are actually pretty cool. This ETF holds a massive portfolio of roughly 1,000 stocks designed to track the performance of the largest US stocks. The holdings are selected based on the following 4 fundamental measures of firm size: book value, cash flow, sales, and dividends. The ETF is then weighted according to a stock score across the criteria. These calculations are done on an annual basis, and the fund is adjusted and re-weighted accordingly. And it's no surprise that the ETF's top holding this year is in Berkshire Hathaway, which is Warren Buffett's company. And since Buffett is the all-time investing GOAT, I think it's safe to say Invesco does a good job of choosing what to include in this ETF. PRF currently pays a dividend yield that's a little on the lower side at 1.71%, but it makes up for it with a great historic appreciation. The fund has returned an average annual return of 13.61% over the last 10 years, which is very high. If you had invested $10,000 into this ETF 10 years ago, your investment would now be worth $35,823. The expense ratio on this fund is a little above average at 0.4%, which means that you would pay $40 annually for every $10,000 invested. Coming in at number 6, we have a Vanguard fund called VYMI, Vanguard's International High Dividend Yield ETF. This is the perfect dividend ETF if you want to gain exposure to stocks outside of the US. Maybe you think the government went a little too crazy with the old money printer, and now the outlook for US stocks isn't looking too hot, so you want to diversify your portfolio portfolio away from the US stock market? Well, this fund offers global exposure to 1,380 stocks outside of the US. Some of its holdings are companies that you would have likely heard about, such as Nestle, Shell, and Toyota. You can see the portfolio composition here. The highest proportion of stocks are European, followed by Pacific and emerging markets. It's the 22.2% share of emerging market stocks that make this ETF the most risky one on the list. Emerging markets is another term for developing nations. These countries have weaker economies, which means that the stocks from these countries are likely a riskier investment, which is probably why Vanguard's risk rating is a 5 out of 5 for this ETF. This ETF shows why high diversification does not necessarily mean low risk, because this ETF offers the best diversification on this list, but is also the riskiest. VYMI has a strong focus on high-yielding stocks with a current dividend yield of 3.48%, which is more than 3 times the typical S&P 500 stock. This ETF was created in 2016, so we don't have a 10-year annual return we can look at, but its average annual return since inception is 9.01%. It also has a relatively low expense ratio of 0.22%. At number 5, we have VIG, which is Vanguard's Dividend Appreciation ETF. This fund seeks to track the performance of the S&P US Dividend Growers Index, which represents a group of companies that have increased their dividends annually over at least the past 10 years. This ETF currently has a dividend yield of 1.69%, which is on the lower side of this list. But as a general rule, the lower the dividend yield of an ETF, the more likely it is to experience higher growth in terms of price appreciation over the long time horizon. And VIG has clearly obeyed this general rule, since it has averaged an annual return of 13% in the last 10 years, meaning your $10,000 would be worth around $33,946 today. Compared to other dividend ETFs, VIG is more concentrated in growth companies in higher growth sectors such as tech, so it is more on the riskier side, but it is still a dividend ETF at the end of the day, so its risk level isn't as high as other types of stock investments, but it is certainly on the riskier end of the ETFs on this list. VIG also has an incredibly low expense ratio of just 0.06%, which means you would pay $6 annually for every $10,000 invested in this fund. 0.06% in fees is really good and ties for the lowest expense ratio of the ETFs that I'm covering today. The provider of this ETF, Vanguard, is one of the longest standing, most reputable providers of ETFs in various funds. This is the most popular dividend ETF currently on the market, with $66 billion in assets under management, so you can't go wrong with this one. Moving on to number 4, we have another iShares ETF, DVY, also called the iShares Select Dividend ETF. This ETF is designed to provide diversified exposure to high dividend paying US stocks. Currently, it holds 99 stocks, most of which are large cap stocks, and all of which have a 5-year record of paying dividends. Currently, the ETF has a dividend yield of 3.24%, which is pretty good. The ETF has also had an average annual return of 12.41% over the last 10 years, meaning a $10,000 investment in this ETF would now be worth $32,214. The expense ratio on this fund is slightly above average again, at 0.39%, which means that you would pay $39 annually for every $10,000 invested. Overall, I wouldn't say this ETF excels in any particular area, but it does, however, score pretty well across all the different factors. It has a good yield, is well diversified, has a long history of dividend payment growth, and has a decent expense ratio, making this overall a pretty good choice. But if this isn't the one for you, there are a lot of better ETFs to come, so make sure to stick around to the end of the video. At number 3, we have a really great ETF. NOBL, which is the ProShares S&P 500 Dividend Aristocrats ETF. NOBL tracks the S&P 500 Dividend Aristocrats Index, which is made up of stocks from the S&P 500 that have increased their dividends for at least 25 consecutive years. As you can imagine, a company increasing their dividend for 25 years is no simple feat. If you think about it, in the last 25 years, the US has experienced 3 recessions: the dot-com crash of the early 2000s, the 2008 Great Recession, and the recent 2020 recession, which means that during all of these hard economic times, the 65 stocks in this ETF were still able to increase their dividends year after year. So this is definitely the best ETF for you if you're prioritizing ETFs with a good track record of dividend growth. NOBL currently pays a dividend yield of 1.94% and was created just shy of 10 years ago. So again, we don't have a 10-year return we can look at, but the average annual return since inception is 13.01%. NOBL also has a below average expense ratio of 0.35%, which is not too shabby. Coming in at number 2, we have VYM, which is Vanguard's High Dividend Yield ETF. This ETF seeks to track the performance of the FTSE High Dividend Yield Index, which measures the investment return of common stocks of companies characterized by high dividend yields. Altogether, it holds 405 stocks, with high concentrations in the financials and consumer staples sectors. VYM is known to be quite volatile, but the good news is that the majority of the volatility this fund has experienced has been on the upside, not on the downside. VYM currently pays a dividend yield of 2.66% and has averaged an annual return of 12.22% over the last 10 years, meaning an investment of $10,000 made 10 years ago would now be worth $31,674. And this fund also has a very low expense ratio of 0.06%, a cost of only $6 annually for every $10,000 you have invested. Finally, at number 1, we have SCHD, also known as the Schwab US Dividend Equity ETF. Charles Schwab is one of the most trusted companies in the finance world, and its funds are known for their fantastic performance. SCHD was designed to track the returns of the Dow Jones US Dividend 100 Index. It holds 104 stocks and provides exposure to many of the strongest dividend players in the United States. Currently, the SCHD pays a dividend yield of 2.89%, which is one of the higher dividend payers that I've talked about today. This ETF has averaged a really good annual return of 14.35% over the last 10 years, meaning an investment of $10,000 made 10 years ago would now be worth $38,226. And this fund is tied with the lowest expense ratios on the list at 0.06%, a cost of only $6 annually for every $10,000 you have invested. The fact that this ETF pays a high dividend, has the highest annual return in the last 10 years out of the ETFs I've mentioned, and also ties with the lowest expense ratio are the reasons why this dividend ETF is my number 1 pick. But I hope you found my list helpful and that you enjoyed this video. If you did, make sure to leave a like down below, and I'll see you in the next one. Take care.